Hi, I'm Bryce Knorr, Senior Editor of Farm Futures Magazine. Welcome to The Buzz for Friday, June 28, 2013. Market analyst Paul Burgener joins me to discuss another USDA report that did nothing to quell market volatility. Indeed, bull spreaders had a field day in corn and soybeans, where old crop supplies remained very tight as effects of the 2012 drought linger. What a difference a year might make, however, if USDA is right with its acreage estimates. For soybeans, USDA put June 1st inventory at 435 million bushels, a little less than expected. The low number, coupled with what's likely to be a late harvest, might mean end users must somehow stretch supplies even longer. July futures went on a tear this week, gaining more than $1.25 to reach its highest price since the day before the highs were set last fall. November futures went in the other direction. USDA's estimate of 77.7 million acres was actually a little less than trade guesses, but coupled with good crop ratings, it raised the specter of a 3.4 billion bushel crop. While that might not make supplies too burdensome, it could still pressure prices to $11.25 at harvest. Paul, those acreage numbers are still in play because USDA announced it will resurvey 14 states for its August production report. What do you think the agency will find, and what's the outlook for prices now?
Well, you know, Bryce, if there are big increases in those soybean acres, it could be an overestimate of the corn acres that we've seen just today. Now, the other issue there is that we're not really planning to reassess the corn acres, so we might not be surprised to find another 300,000 to 500,000 acres of soybeans out there. I do think that that will bode maybe better for corn prices than soybean prices if that does happen. Prices are going to have to be work hard to stay above $12. I think especially if the weather treats us right over the next few weeks. And a break below that $12 could see a slide to $11.50 pretty darn easily. So we need to watch this soybean market, see what happens with it. But good weather could really impact those new crop beans.
USDA's reports for corn followed a similar storyline to soybeans. June 1st inventory was less than trade guesses, presumably due to better spring feed usage. That helped send July corn higher. But USDA's forecast for new crop acreage was even more bearish. The agency raised its forecast of plantings to 97.4 million, a little more than March intentions. Traders expected a 2 million acre decline, so the market's reaction was swift. December futures plunged to new contract lows, closing at $5.11. If it's correct, USDA's acreage suggests potential for a crop of more than 14 billion bushels if current crop conditions hold. My model puts the selling target at just 458 to 518, suggesting the market is taking the USDA forecast at its face value. To be sure, this June report has overstated acreage in 15 of the past 20 years, though things may not be quite as bearish as they seem. But without threatening weather, turning the market around may be tough. Funds were sellers today, and they've turned net short in corn. Even more troublesome is the trend for investors to flee commodities in general. Gold rallied today to stay above $1,200 an ounce, but not before suffering its worst quarter in history. Paul, we've recommended farmers cover 40% of their 2013 crop with sales, which should lock in at least a little profit this year for those with adequate revenue protection coverage. Indeed, you think RP was the reason USDA found so much corn? And how likely is their estimate to hold?
You know, absolutely. I think that revenue protection program puts a floor under the crop and gets it in the ground, much like it did with wheat in the plains last year, as we kind of look at what happened last fall with that. It's not inconceivable that a lot of guys will plant that crop and see what happens with that strong revenue protection under there. I don't think we're likely to hold all these acres. I do think that when we reassess that soybean number, that could play a role in what happens with these corn acres, but I'm not sure that they're all there. I do think that USDA hedged their bet a little bit with this by dropping the harvested acres from 89.5 in the June supply demand report to 89.1 in this report. So we do see a change there, and I do think there is a little bit of hedging on their part. It might not be enough to hold 550 corn without something in the weather. So I think we'll have to watch closely to see what the weather does to us, especially the last part of July with all those corn acres getting planted really at the same time.
Wheat was almost a bystander today. Farmers in much of the country are busy with harvest, and the usual hedge pressure added to the negative tone in the market spilling over from corn. Futures in Kansas City and Chicago made new lows, something that might have happened without the USDA report anyway. The government gave and took away with its numbers today for wheat. On the plus side, June 1st stocks at the start of the new marketing year were put at 718 million bushels, 28 million less than the agency's estimate from earlier this month. Presumably more wheat worked into feed rations this spring to replace hard-to-find and high-priced corn. But the government also raised its forecast of acreage despite a decline in spring wheat and durum seedings caused by terrible conditions on the northern plains. Winter wheat seedings were 2% more than previously reported, according to the government. The reports put the burden for rallies on demand, which is mixed. Exports have been good to start the marketing year, and stocks of high-quality wheat could be somewhat tight this year around the world. But are there enough customers to buy that wheat at a higher price, Paul? And what should growers be doing as their revenue protection runs out?
You know, I do think that feeders are going to be actively buying wheat right up until corn harvest. Right now in the plains, we're seeing somewhere between a 60 and 80 cent discount for wheat versus old crop corn. So I think there is some, at least some demand that's built in there. Exports have looked strong early. We'll see where that goes as we go forward and how it supports itself. But it has been there, and I think if we stay priced competitively, we can stay strong in that export market. We might look at pricing out into the winter. It does look like there's a little carry in this wheat market. Maybe do some pricing in some December or March contracts to protect ourselves with this wheat that we've got in storage and the revenue protection has run out. That's one way to kind of prevent some issues down the road there.
Well, thanks, Paul. Independence Day is next week when we'll be back to see if the markets are ready for fireworks or just a dud.
We'll have to have more margin now, there isn't any doubt. So you better dash with a load of cash or we'll have